This is very frustrating. Right, so I'm kind of in a weird situation as far as streaming goes. Um, I got to make sure that uh, there we go. I have to be really conscientious of the battery life that my laptop has, but the connection is just being spotty for me. And yeah, so I'm about to hop back in.
what happens is when a retail trader sends them seconds. The execution, the fill report goes back to the retail trader, and it is printed on the ticker tape, right? If you think sort of movies and TVs, you think of that ticker tape, or if you think of CNBC and you see those trades happening along the bottom, that's the tape where all trades are printed. Now, off-exchange trades are printed to something called the Trade Reporting Facility, the TRF. There are 3 of them. One operated by NASDAQ, one operated by NYSE, and one operated by FINRA. But I believe the main one is the NASDAQ TRF. And that's like 35% of the 43% happens on the NASDAQ TRF, and the rest happens on the NYSE TRF. So in the market, as quoting and trading is happening, this is really important because I get this question so much. And can dark pools or off-exchange trading impact prices? The answer, of course, is yes. And you need to understand this mechanism of quoting and trading that's taking place in the market, right? These quotes are being put on exchange, and every computer in the selling, trying to understand supply and demand dynamics. And a lot of these high-frequency trading systems are trying to understand what's going to happen in a millisecond or 2 milliseconds. Where is this going to tick up or tick down in the next 500 microseconds? And if it is, I want to position myself ahead of it. And so there's, every trade that takes place off exchange or on exchange is being read by these computing systems and profiled. And so when you talk about price impact, that's that mechanism for impacting the price.
That's actually an amazing explanation. I appreciate you going in depth on that. One common question, I got a bunch of questions from retail investors. They were DMing me question to ask for you. A lot of them regarded around fines, the concept of fines towards companies. And I actually cross-referenced that also to Charles Payne's interview with Stephanie as well. And she went over some fines and justifications for faulty actions in the market, like the 2016 Barclays. Not going to go into the detail on that, other than the fact that she did mention that in quotations, allowing HTFs into their pools and allowing them to front run. Now, basing off the front running definition, trading stocks or any asset based on insider knowledge of future transaction that affects the price. The question I'm trying to get at to you here is because that information is already out there. But is there a difference between front running and then electronic front running?
It's a very good question, and it is a very controversial topic. So, you have to understand everything that I'm expressing here is an opinion, and what I'm about to express, yes, is an opinion, right? Like, I'm telling you some facts about how markets operate, but this kind of question is very much a controversial thing, and this is the sort of heart and soul of Flash Boys. And I don't know if you've read the book. A lot of people in the industry don't think very much of it. I happen to, and I happen to be in the book. So, but I'm anonymous, so I like that, and I think that was the best outcome for me. And I'm just going to leave it at that. But I think that there was an important message in the book, and it dealt with conflicts of interest, and especially about poor broker routing technology. And nobody would debate that part of it. But this question is what everybody debates, and it's what at IEX we would call electronic front running. And I've since sort of come to refer to it as structural arbitrage. And when you think about this, first, you have this conflict of interest from an institutional broker like Barclays. They're getting huge orders from institutional asset managers. So, a pension plan comes to them, they say, I want to buy 1 million shares of Microsoft, right? And that's a huge order. So that order needs to be put into an order routing algorithm and broken up into 100, 200, 500 share chunks. And because this broker is incentivized to keep their costs as low as possible, they're going to start by resting that order in their own dark pool, where nobody can see it. But if someone happens to come along who wants to sell 1 million shares of Microsoft, well, that's a great outcome and everyone's happy. It doesn't happen very often, but it can. But then they're also going to take a piece of that order rest in their dark pool. They're going to take the rest of it and they're going to break it up and slice it up and route it. And the first place they're going to hit is their own dark pool. So they're going to send some aggressive offers into their own dark pool, trying to buy at the offer. Now, Barclays, in this very specific case, and really many of the other large brokers did very similar things, advertised to asset managers several things. But one of those things was that they would not let high-frequency trading firms co-locate in the dark pool. I guess I don't remember specifically if that was Barclays. I should caveat it, but it was one of the other big brokers. And that they would measure the toxicity of counterparties and allow institutional asset managers to opt out of interacting with highly toxic counterparties. That's a lot of jargon, I know, but basically what it would mean is they would watch out for high-frequency trading firms and allow you to opt out of interacting with them. So if you're the high-frequency trading firm and you're in the Barclays dark pool and somebody suddenly hits you with a bunch of Microsoft, you can be pretty sure that there is an extremely large order in the system being routed right now to buy a whole lot more of Microsoft. So you can imagine that Barclays, as an order router, would send 500 shares into their own dark pool and then send 10 more orders of 200 shares each to each of the stock exchanges. Now, this gets very complicated, but Barclays would underinvest in telecommunication lines, and the high-frequency trading firms would have the absolute fastest telecommunication lines. It's actually an area that I happen to have a whole lot of experience in. And so I, as the high-frequency firm resting in the Barclays dark pool, where I'm not supposed to be allowed to interact with this order flow anyway, see this order, know or think probabilistically that there are more orders going through the pipes, and I race ahead of them. Because I've got, later on there were wireless links, but, let's say I've got very fast point-to-point leased lines, fiber optic, and I've made sure I've worked with the telecommunications company to reduce the distance as much as possible. Whereas Barclays doesn't care. Those orders are going all over New Jersey before they ever get to the data centers. And, they get stuck in traffic on the Garden State Parkway or something, But anyway, by the time those orders have gotten to the exchange, I, as the high-frequency firm, have taken out the offers. And so those orders all miss. The fill rates drop very low. And so now Barclays has to send another spray of orders out at a higher price level because, that price level was just taken out. And then I, as the high-frequency firm, which bought a bunch of shares, now I'm sitting at the best offer, and Barclays comes and hits me, and I sell those shares. And so I just made a very easy profit. So that is the sort of IEX definition of electronic front running. And there's no doubt that it was happening. And you could tell by the fill rates. A lot of people would argue that it's not as easy as I just described. That they would, but I think it was for a long time relatively easy, and a lot of people made a lot of money doing it, and it cost institutions a lot of money too.
That's an outstanding explanation, by the way. Thank you so much. That cleared so much up. That's awesome.
Sure.
Yep. Now,
what's the incentive, Dave? I do want to step on that real quick. What's the incentive for Barclays to have slow wires? Do they make a little bit on each trade, so every time it doesn't get filled, they're making a penny on each trade for each block, or why would they actually?
They're only getting paid for shares that they execute, but Barclays wants to keep their costs low, so they take the cheap lines that wind their way all over New Jersey, and then the telecommunication company knows that they can sell the expensive lines to the firms that really care about it.
Makes a lot of sense. Okay. I thought it was maybe somehow beneficial to work with them, even though they weren't supposed to. But that makes a lot more sense that they were just cutting costs because they don't need to.
Yeah, I mean, a lot of the conflicts of interest that you find in markets are this misalignment of incentives, where people aren't getting compensated in the right way, or their interests are not aligned. They're trying to minimize costs when they're routing orders rather than maximizing execution quality. So, that was one of the decisions that RBC made before IEX, was to develop this latency normalization technology to combat this. And they called it Thor. And what they would do is, instead of releasing all of those orders at the same time, as I just described, they would slow some of them down, and they would release them so that they arrived at the same time. And that just fundamentally transformed the fill rate that they were getting, it from like 60% to 95%.
So then the price that cascade up.
Hey, Dave, I got a question for you. It's sort of within the same realm here. But first off, thank you so much for coming on. I admire your work and everything that you've done, and it's been a huge insight to everything. So thank you so much for being a part of the conversation here. I was just curious, if you were to come up with pseudocode-esque areas of interest for high-frequency trading, is there anything that you can kind of abstract and convert to English for us who are just figuring out the semantics of high-frequency trading? Like, what are some of the targets or some of the areas of incentive where an HFT would want to take advantage of a particular indicator, a particular, I don't know, buy or sell wall? Can you give me some insight there?
Yeah, I mean, a lot of these trading strategies, there are diverse trading strategies to a certain degree, but a lot of them are very speed sensitive. Most of the time, they're really trying to understand and categorize supply and demand. So they do things like calculating micro prices or fair value calculations, which will give them an indication as to whether something is trading sort of at a discount or premium to fair value. So let's just take like the simplest sort of market making strategy. I'm posting bids and offers, and I'm hoping to capture the spread. And so as something trades, sort of rich to its current price, I'm going to lean on the offer. I want to sell more than I'm buying, and then as that supply and demand curve shifts and changes, then it might be at a discount, and I want to start buying, and I want to sort of keep capturing the spread as this, as the price kind of ping pongs in between the bid and the offer. So at the limit, the market maker is happiest with the market not moving at all, them being the fastest participant, and it just trading between the bid and the offer constantly. There are all sorts of other strategies. You start looking at correlated instruments like futures to ETF arbitrage, ETF to underlying, that kind of arbitrage, interlisted arbitrage. There's event-based trading, where you're trading news events or auctions like I was describing. But sort of, I think the best way to think of these things is they don't want to take inventory risk on. So they always want to be flat. They move very fast. And I mean, at this point, look, my knowledge is dated because I think that basically, you can I've got a good slide. I think I actually put it on Reddit after the AMA I did with Superstar, but it kind of tried to categorize HFT trading strategies on this spectrum of sort of, I think you could look at it as beneficial to harmful. And I think a good way to think about, what's a beneficial versus harmful trading strategy, I tend to think of it in terms of active to passive ratio. So a trading strategy is active as trading strategy is, the more it's taking liquidity, the more it's trying to push prices or capitalize upon price changes. And you can look at some of the studies that IEX have come out with to see, I think for some exchanges, half of all trading takes place within the 2 milliseconds before and after a price change. So, that kind of tells you what this speed race is like. How it happens in a flurry constantly throughout the day, and how trading gets concentrated into these sort of minute time periods when prices are changing, and all of these computing systems are trying to manage that price level transition.
Gotcha.
I don't know if that answered your question.
No, I apologize. That was a super broad question, and I know that HFT trading in general is just it's its own thing. It's its own concept, and it was just a very broad question. The last little thing I want to ask in lieu of that is it fair to say that I know that HFTs are just kind of like an algorithm of algorithms, so to speak, and it's constantly trying to curate and sample and ultimately improve itself, whether that's through hard-coded means or through artificial intelligence. Is there ever a kind of an abstracted layer of sentiment-based trading and how it can actively parse certain securities that can move together, move inversely of each other? Anything along those lines?
Oh, sure. I mean, so much of HFT is like correlation-based trading. I mean, the earliest days of quantitative trading were pairs trading, and a lot of that is still around. You also can go sort of a level up from the high-performance systems and get into statistical arbitrage strategies, which trade pairs, trade ETF constituents, like I was describing. So, I do think actually part of what HFT does is reinforces correlations and actually brings us what are called correlation 1 events, which are like the flash crash or things like that, where these illiquidity contagions can happen. And so the short answer is yes. I don't know if you could say there's a whole lot of artificial intelligence. It's sort of a fine line. It's all math, and some kinds of math are more complex than others. There's no doubt AI is used, but has it transformed trading? Not to my knowledge, at least.
Yeah, no, not in the sense that AI is actively trading on its own. Not like that. I just, like you were saying, statistical reinforcement and sentiment.
Yeah. I mean, there definitely are NLP systems out there. Reddit, parsing news releases, and there have been lots of controversial releases.
If I can, Vic, I'm sorry for interrupting you.
My Twitter just crashed. Hold on, guys. Can you guys hear okay? Is this hopefully entertaining? I'm pulling back my Twitter app. Hold on.
Flashing orders. I think it was Direct Edge. I don't remember, so don't quote me on that. But one of the stock exchanges like flashing orders to a select group of firms, and it wasn't that it wasn't publicly known per se, but it was controversial when it sort of made popular news or got some attention for I think obvious reasons. And so there was a big controversy, and the SEC stepped in and they said this is not okay. and the exchange that was doing it said, oh, okay, we'll stop doing it. And then the SEC didn't actually do anything after that. So they didn't actually outlaw it, which was really stupid. And a lot of people got really annoyed at it. It was like, what? This should be a very basic thing. We can't even do this, you know? And so flash orders are still, as far as I know, not illegal, but nobody's doing them on exchange. But they are done in other systems, all I think pretty much off exchange. So there are a lot of these are called indications of interest. So it's not quite the same as a flash order, but it does give firms sort of the opportunity to decide if they want to take the other side of a trade or not. And so it kind of there are some similarities from that perspective. And these IOIs are used. The indication of interest, the IOI, is used in some dark pools. There are conditional order types. There are IOI order types. There are electronic liquidity providers that are tied into individual broker or algorithmic order routing systems. And sorry, you stop me if I'm throwing too much jargon around at once. You know, it's hard for me to know what people know about or not. But okay, so a lot of these algorithmic order routing systems and institutional brokers systems, high frequency trading firms in their algorithmic order router. And then you have single dealer platforms, SDPs, which, you know, obviously that's people keep asking about Citadel Connect, and Virtu has one as well, which are the larger ones. And so the SDPs are also operated as IOI systems. So you know, yeah, there are sort of some of these, but it's not on exchange like it used to be. Yeah, cool.
That's perfect. That was a great explanation of that. I'm gonna jump over into a different realm here. Okay.
Hey, JB, before you do that, I have one real quick question that I've been waiting to hop in on.
Yep.
So, in regards to Brad Katayama and IEX, as I understand it, with dark pools and high frequency trading, and I guess I really don't understand too much of the connection between that high frequency trading, I guess, is happening on all exchanges, which makes a lot of sense. Two of the main problems are quote stuffing and spoofing when it comes to, I guess, high frequency trading as an issue. And I hear ban dark pools trending on Twitter, but as I understand it, IEX is a dark pool, which attempted to, or has created basically a box with a bunch of wire inside of it to delay transactions into it, which is an awesome solution in my mind. I'm like, wow, that's actually such a pretty basic idea. Let's just take a bunch of wire and wrap it in a box. But do you think that's the direction, is that maybe the dark pools are fundamentally was a good idea in concept that then kind of got taken advantage of, or maybe there's still room for it in the market? Like, I don't really, as when it looks at dark pools, if are they a good thing? Are they a bad thing? Are they kind of like a lukewarm, like, yeah, they're kind of good, kind of bad, depends on the situation? So I wonder what your take was on that.
Sure. So first, IEX is not a dark pool. IEX started as the dark pool in the interest of getting up and running quickly, but becoming a stock exchange was always the plan, and they did become a stock exchange. So that's a fully lit stock exchange, although they have more hidden orders than most other, than any other exchange. So you know that's important to understand. There are dark orders on exchange. There are dark orders off exchange. The long-term stock exchange is just proposed to facilitate the displaying of lit orders on dark pools, and which is how it used to work, in fact. So it's very complex. I think dark pools are very important. I come from the institutional side of the business. I work and have worked for years with pension plans and mutual fund companies and institutional asset managers. And they're, as I described before, they're transacting very large orders. If I'm going to buy 1 million shares of Microsoft and I go stick that order on an exchange, forget about it, right? That price is going to go crazy. But there might can find each other and cross at the midpoint. That is the best possible outcome for the retirees who own shares of the pension plan and the shares of the mutual fund that are in your, IRA, right? These are important considerations. I don't think that. I think dark pools are problematic because there are so many of them. So the chances of those two orders finding each other is extremely low. I think they should be far more limited. I think the broker-owned dark pools have been proven extremely problematic in the past, and we've seen rampant enforcement action in the New York Attorney General's office, the SEC, and the FINRA, all hitting people for misrepresenting what they're doing in their dark pools, mistreating their clients in order to save money or make money or trade against their clients. There's been a huge amount of abuse, but again, none of this has to do with retail. This is all on the institutional side. I do not think that retail orders should be executed off exchange. I think that's the dumbest possible market structure you can have. I think that these are two completely separate issues, and it's important to understand why dark pools are extremely important and useful, and also that it's got pretty much nothing to do with retail.
Yeah, so I was going to actually add in here a question. So basically, off the high frequency trading and dark fibers, it allows them to see the retail trades before they become public. So what are some things that hedge funds can do with that information?
Well, it's not broadly hedge funds, for example. It's pretty much just two market makers, Citadel and Virtu, who control 80% of the retail market or something. So you've got a de facto duopoly. And to me, that's extremely problematic just from a corporate concentration of power perspective, which I tend to see a lot of issues through and think that is one of the biggest problems in our country. When these firms, Virtu and Citadel, see all this order flow, and they're also the DMM on the NYSE and certain names, so they're being given, they're being given privileges and higher rebates and priority over other traders on exchange, and they're seeing all of this sort of material, non-public information off exchange. I think that's really problematic for the reason that they would have, therefore, a better understanding of supply and demand and a better understanding of the trading dynamics in a particular name. But it also damages markets. And so that quote you had from me before about how 70% plus of OTC trading can cause spreads to widen, to me is one of the biggest problems that we face in U.S. markets. Because keeping that order flow in the hands of exchange, and that is profitable order flow to trade against, because retail traders tend not to be able to forecast what price change is coming in the next 10 milliseconds. And so because they can't do that, they're operating at a different time scale. And that mismatch of time scales is why high frequency firms exist, and it's how they make their money. Now, all of that trading volume being taken into these OTC systems of Citadel and Virtu, and all of the trading volume that's sitting in dark pools on the institutional side means that the only orders that actually make it to the lit stock exchanges are generally highly toxic orders, or they have high levels of adverse selection, which means that they are orders that know that a price change is imminent and therefore cause losses to market makers. And that is very problematic because it leads to higher volatility, and it leads to higher execution costs with wider spreads. And one study came out, and I thought it was a very compelling illustration of the issue. And it said spreads are too wide by 25% or more because of this amount of OTC off-exchange trading. And if you were to bring those orders onto the lit exchange, the spreads across the market would narrow, these execution costs for everyone would narrow, and you have open competition for order flow, which I still find it very hard to understand how people who are involved in markets argue against open competition for order flow. It seems really hypocritical to me.
Right.
Yeah.
My take is, when you talk about the futures market, are you also including derivatives like selling calls and selling puts? Because I feel like there's so much money being made in the category of like AMC, GameStop, all those stocks with actually taking a directional position, if you're one of those entities that you're talking about that knows what's going to happen, can they take a directional position and kind of over leverage the market?
Are you saying high frequency firms take a directional options position?
No, I mean, is options kind of driving the market itself? Is the options chain?
Reverse.
So I've never been an options market maker. I've sort of helped build some of those systems from a tech perspective, but it's not an area that I have any real sort of applied experience. But I can tell you, at least it used to be, I don't know if it's still the case, I would bet it is, that when I was aware of it, Citadel was like 30% of the options market. And retail options market making. So, every time you're buying or selling a call or a put, especially in these names that have extremely high premia, you're printing money for them. That's for sure.
Wow, Dave, to add in on here, okay? I want to go over a factor I've seen on Twitter a lot. It kind of went a little bit quieter, and it came to light on the Charles Payne interview, the concept of Citadel Connect and it not being, the filings not being reported to FINRA. What is your opinion on that?
That's wrong. another inaccuracy.
Okay.
So I haven't talked about it, one, because I haven't been feeling well this week, but also I needed to do some research because I didn't know enough about it. Citadel Connect is not something that existed when I was there, and even if it had, I wasn't really involved in the group, so I wouldn't have had any knowledge at all. So I needed to spend a little time because I wanted to make sure I had this very accurate. And I spoke with someone who you probably could not find a better expert in the space. And so he was kind enough to explain all this to me. So Citadel Connect is an SDP, single dealer platform. As I said before, there are others. Virtu, for example, runs one. That's another very popular one. The single dealer platform, basically, here's a good example. A retail trade comes in. Citadel decides that it doesn't want to take the other side of that trade. So it puts it into Citadel Connect. Citadel Connect is a ping pool. So here, basically, it allows for IOCs in, and it'll sometimes IOI out. And I actually should preface this. I'm not saying anything, as far as I understand, specific to Citadel Connect. I'm talking generally about single dealer platforms and of the kind of single dealer platforms that you find in the retail space.
Yes. And I want to confirm that's how I want to discuss that as well, Dave. I just wanted to confirm.
Yeah. So let me take a step back and say, like I said, I don't have any internal knowledge of Citadel Connect, but speaking generally, as I understand about SDPs in the retail space, is they can put an order into there, a resting order, for example, or a marketable order, and that is connected bilaterally to many different firms. And so it could be that some institutional asset managers are actually connected to it. And it could be that some brokers are connected to it. And maybe Citadel and Virtu are connected to each other's as examples, right? And other high-frequency firms. And so this is what's called a ping pool. Sometimes it's referred to as an exhaust pipe. And so the order will go in, and if they want, they can IOI it out. So to people that are connected to them, they might give them an indication of interest. Do you want to take the other side of this? Or they can allow those firms to IOC in, which is an immediate or cancel order, and maybe it'll hit something and maybe it won't. And so without getting into the specifics about how that really operates, just know that every time there's a trade in one of these SDP systems, it is an OTC trade. And he explained it very simply to me. Anytime a trade is printed, a trade executes off exchange, it gets printed to the trade reporting facility. There are some exceptions around riskless principle that gets extremely complicated, and it's really mainly to avoid double counting or double reporting trading volume. But anytime there's a trade, it is printed to the trade reporting facility, and of course, every single order and trade in the market is reported to FINRA. And all of the trading volume that happens in these SDP systems is reported on FINRA's transparency website as OTC volume. Now, it's not as transparent as you'd like it to be, right? I would rather see OTC trading on FINRA's website broken out by SDP versus internalization system. I think that would provide more transparency. But anything that you've heard or read about trades on these STPs not being reported to FINRA, not being reported to the tape, that's incorrect information. It is all reported and printed.
Well, and then that's the thing there, is because that was on national news, and the fact that Stephanie Cameron used Citadel Connect virally on the news, I thought it was interesting to bring in your perspective on that. I got an additional question on top of that fact. You're discussing about the OTCs market in general. Do you find that compared to the past and now, is the OTC market becoming more of an issue to the market in general?
Yeah, that's exactly what I'm talking about, that there's too much volume happening OTC. And this is something that is illegal in every other major developed country. Canada has very sort of elegant, succinct rules that I think should form a model for what we do here in the U.S. And in Canada, they say if you want to exchange, it has to have material price improvement. And they define material price improvement as a full tick, or if the spread is a tick wide, half a tick. You want to execute something off exchange, that's the level that you have to price improve that trade in order to compensate for the damage being done to markets. And so in Canada, you only have 7 or 8% off exchange trading, as opposed to that number I said earlier, which what was it, I think 46%. That's a huge 43.8%. That's a huge difference. And it's the same. The same is true in Europe. The same is true in Australia. The same is true in the UK. They have all come out and they have put rules in place that ban payment for order flow and that ban off exchange trading without material price improvement.
Yeah, so and then we're kind of going off each other here perfectly, Dave. So I wanted to tie in here. So based off, you interviewed with CNBC, and then they started discussing after the fact when you got off the air there. Now, being them, I'm thinking he's referring to retail investors. Went to raw, but now in regards to the factor of American soil, I'm a Canadian personally myself. Now I'm going to get into the topic of PFOS. In regard to how do you think that PFOS allow market makers to control the flow of the market?
So you mean PFOS, payment for order flow?
Yes, payment for order flow, correct.
Yeah, so I mean, the thing is, you don't actually need payment for order flow to get the trading volume. So Fidelity, for example, does not accept payment for order flow, but they still send all their orders to Citadel Virtue. And it's a problem because it's allowed. And that's what I'm talking about in terms of we shouldn't allow that, and we're the only country that really does. And it's also a problem that it's needed. And the reason it's needed, it starts to get pretty complex, but it all kind of wraps into current regulatory structure in the market, which is a self-regulatory structure, and exchanges are self-regulatory organizations. So we're the Wall Street is the only industry that I'm aware of in the U.S. in which publicly traded for-profit companies regulate themselves. And in doing so, they also, because they're self-regulatory, they get they're quasi-governmental. They're like an extension of the SEC, and therefore they have certain kinds of immunity. And the problem comes when there's a problem. So, for example, you take the Facebook IPO, which was many years ago, and it went terribly for NASDAQ. But NASDAQ was immune from any liability because of that, because of this quasi-governmental self-regulatory structure. Whereas, if I'm Fidelity and I'm trading with Citadel, I can hold Citadel liable And so if you ask Fidelity, they're going to tell you that's why they still go to Citadel, because they get price improvement or size improvement, and because they have this liability protection that they don't have to deal with when they deal with exchanges and face off against exchanges. And all of that is problematic. But payment for order flow is just kind of the cherry on top of what you call undue influence or inducements to order routing that further divorce execution quality and customer protection considerations from the broker routing decision when the broker is routing for payment and to increase their own earnings versus improving execution quality for the clients.
So that stems back into your first point and how the actual market moves, or how it's supposed to move, which is the supply and demand of a bid and an ask. And if you see moves in video where, you know, it's like 77% dark pool for its 20-day average, when obviously they got the ADP deal and the stock split news, that's obviously for the benefit, right? There's too many people trying to go long at the same time, and that would have forced the stock way too high. Is that kind of the beneficial side of having a dark pool?
Yeah, right. Like, you know, if you're trying to put you know, a large trade on, you know, being protected from everyone seeing that you're trying to do that can be a good thing.
It's a bait and switch.
You know, and basically help you improve your execution costs.
Right, but that's crazy. So Citadel and the OTC trading is all done through the market makers, right? And the market makers own the options market, and they're essentially selling the options too. It just seems like an absurd amount of.
It's a buffer layer, basically, right?
It's just absurd that they have
liquidity
that much power,
buffer layer.
They can take a directional position on things that's self-regulatory.
Yeah, I mean, you know, a large market maker has a ton of information about supply and demand, and you know, they can act on that, and also by those orders going to the market maker instead of the exchange, you know, the national best bid and offer doesn't reflect supply and demand as well as it could, and that's when the NYSE, you know, when Stacey Cunningham from the NYSE came out and said this very thing. This is what she was talking about, which is that, you know, this is leading to artificially wider spreads.
Can you guys hear me? I have a question.
Yep.
Awesome. I can't see the call at all. It's completely glitched for me. But I have a question, another question, DMs from someone named Painter. He was asking Dave if it's possible to keep the volume of AMC or other stocks from being suppressed. He was stating that over 70% of our true volume is on outside markets, aka Citadel Connect and other dark pools, while around 20 to 30% is reflected on the NYSE and to the brokers we use. Our true daily volume is not 60 million or less and is actually way more. They're making it seem low so that we don't trend number one on the volume list of every retail brokers, and basically he's saying it could prevent FOMO.
Right. So that's what I was explaining earlier, is how that's just not the case. So even though something is trading off exchange, even though 70% of the volume is happening in these internalizers, every trade is reported. And so that's how you know that 70% is happening, because you're getting 100% of the reports and 70% of them are marked off exchange, and the other 30% are marked with the exchange that they're happening on. And so
are they reported to FINRA?
They are reported to FINRA, yes. So that's the
because
other thing I was explaining about the
Citadel Connect
SDP.
does not report to FINRA.
Right.
But
So
maybe they've updated.
No, that was never
internalizer.
the case.
It's an internalizer. SDPs would report to FINRA.
All report at first to the OATS system that FINRA uses to surveil markets. Later on to the CAT, Consolidated Audit Trail, and it's not that these
It's a
are
split.
perfect systems. They all have issues, but every trade is reported. And then I think what most people are talking about here,
can I interrupt you really quick, just because this article does say that unlike Apogee, Connect is not classified as an alternative trading system and does not report volumes to FINRA.
Right, so that's wrong. So ATSs are regulated by FINRA, and STPs are not in so much as they're their own system, but they are still being run by a broker dealer who is regulated by FINRA, and every SDP trade gets reported to the tape and therefore is part of the FINRA transparency report, part of OTC reporting on FINRA's transparency website. So that, like I said before, that information is incorrect as far as I understand it.
So it's a semantic thing.
I think the issue, I would talk real quick, I think the issue is that if 70% of the flow is going, to a dark pool or OTC, and we have high frequency hedge funds trading, algorithms and taking directional positions and making money, on the derivative chain. I mean, they talk about it a lot, how much money is being made on, specifically right now selling calls. And it's a very riskless trade, especially if you know that the market makers are going to allow you to take a position without affecting the price, if that kind of makes sense. And that's, I think, what he was stemming into when he was saying that like a full tick is needed for a Canadian dark pool.
Right. So to execute off exchange in Canada, you have to materially price improve. And to me, that's just a better model. It gets better outcomes. It actually reduces execution costs.
Forcing an entire fill instead of a fractional fill.
Such as liquidity, because obviously the U.S. is a more liquid market and company size. But there was a good study put out by actually an HFT firm called XTX, who agrees with most of the things that I'm saying here. But yeah, I did want to correct that bit of misinformation, because I've seen that repeated many times in terms of how these SDP systems like Citadel Connect work.
Yeah, it's actually a news article that was published, so it's not just a made up. I can give you the
I know. I remember seeing it.
Yeah, he mentioned he looked into it. And again, it's okay if we disagree, but we're not going to continue to disagree about that.
And I
had some missing volume.
And I'm not trying to defend STPs.
No, I appreciate you clarifying. I just had a question regarding it. Thank you so much.
Sure.
I was trying to introduce averaging.
Jelly's trying to say something. He's got a question. Jelly, what are you saying?
Well, I do have a question. Number one, I was going to confirm what, in my digging, what I found on that is I debunked that article a while ago as well. Not specifically on Twitter, I'll put up a write-up about it. But I do agree with Dave that article was skewed. There are a couple of ways that the reporting to FINRA can be
evaded. It's
not put in there under the regulations, but they have to be reported somewhere. So they either have to be reported on the tape or somewhere else. And that ultimately gets back to FINRA. So it may not be a direct reporting structure to my understanding, but I agree that article was absolutely incorrect. And I'll say that in my retribution.
So volume in dark pools is reflected in light, like it's there. Is that what you're both saying?
It's all on the market data. Yeah, it's all on the trade tapes. It's all in the market data. Every trade in the market is published, and every trade that happens OTC gets printed on the tape at a trade reporting facility, and any trade that's printed on the trade reporting facility is included in FINRA's transparency report.
And how long though?
Someone mic has a lot of backbeat, JB. Maybe they could mute, or you could mute them in between, because it's really hard to hear Dave when there's all of that backbeat going on. I think they're driving.
So if you can go to otctransparency.finra.org. It was a great thing that they came out with. We pushed very hard for them to do it. They at first charged money for it, and we pushed very hard to make it free. And so this is actually one of the things I was really proud of helping to make happen. And so you can see by stock how many shares are trading on ATSs, which are dark pools. You can see by dark pool how many shares are trading on it. It's some of the reports are 3-week delay, and some of the reports I think are 2-week delay, or maybe they're all 3-week. It looks like. So everything right now is as of the week of July 5th. I think it's all 2-week delayed. I think we changed that.
And so I was just in some 90 to 120 day delay type of things.
myself.
Yeah, I mean, this is the thing. This was very much sort of pushed back against in terms of getting shorter delays because brokers express concerns about reverse engineering. But anyway, 2-week delay was pretty good in terms of what we were able to get. And it lets you see how things are trading. And so, for example, the last time I looked at GameStop and AMC, and you could see that something like 90% of off-exchange trading was happening OTC, whereas only 10% of trading was happening in ATSs of the off-exchange trading. And that's why I say that dark pools really aren't the issue here, because it's about OTC trading, which does not happen in dark pools, not ATS trading. That's what a dark pool is, an ATS.
Yeah, and just to add into that, Dave, I got another question for you here too. I know you're getting thrilled with questions. I appreciate you just going bang, bang, bang through them all. But so if a broker-to-broker transaction happens as a riskless principal trading, as not to count the tape twice when they send the trade via dark pool, is there any way a price can be suppressed by using blocks?
So I've heard this before. I don't think so, because when you do riskless principal, you're doing it because, and look, this is not something that riskless principal, I've tried to learn more about it. I've asked a bunch of people who would know better than I do. I've gotten different answers. I don't know that a lot of people, except maybe the ones using it, really spend much time thinking about it. But my understanding is if I want to facilitate a riskless principal trade, I'm doing that because there was already one execution that printed to the tape. And now I am going to internalize something without taking any risk, and either side of the trades are reported. And if I were to report my riskless principal trade, then I would be reporting double the number of shares. And so, but you have to remember, when a retail trader sends an order to their broker, they're getting a trade, they're getting their execution. If it's marketable, they're getting an execution, in less than a second. So the idea that one of these market makers could be bunching them up into a block in order to manipulate the trade, because all those trades that they're getting in less than a second aren't printing, I don't see the mechanism for it. All of these things, if you wanted to sort of present a case for it, I mean, I get that there are theories around, but I think you have to explain the actual mechanism, and I haven't seen that in a way that makes sense to me. So, I'm not trying to say it can't happen. I'm just saying I don't know how it could, or it's not something I would have experience with or see how it would.
Yeah, and then to expand on that too, then here, I got another question for you. First, I want you to explain what internalization is, and then the following question on that is based on how can internalization be used to a market maker's advantage?
Yeah, so let's say I'm the market maker on the other side of your order, and you're coming around and you want to buy 100 shares at $50, and it's the stock is trading $49.98 by 50, and so so I see the market and I see that it's stable, and I have a reasonable expectation that there's a sell order coming from another retail trader probably pretty soon. So fine, I'm going to sell those shares to you at $50, and as soon as I do, another order comes in from another trader. They want to sell it, so I'm going to buy that back and close my position at $49.98. I'm going to pocket that 2-penny spread. Now, maybe I'm going to offer each of them a 1/10 of a cent of price improvement, which is not much, but it makes it so that I can make numbers look really good in my disclosures. Again, that's getting into the sort of material price improvement in other countries versus what the U.S. does. And so, I think that's how you theoretically make money. And there are, complexities upon complexities on top of what I've just described, but at a very simple level, that's how to do it. And by the way, someone is helping me better understand riskless principal in my DMs, a good friend, and he's explaining that riskless principal is when a dealer receives a customer order, routes out to the market as riskless principal, fills the order in the market, which prints to the tape, And then the dealer has this internal process where they flip the exact share quantity and price directly to the customer. So again, that's the mechanism for doing a risk principal trade, so you don't double report that trade.
Nice. So I have a quick question real fast. Considering I am a cat, I would like to know a little bit more about what your thoughts are on the consolidated audit trail system, the CAT system that is being implemented. I think it's really interesting, and I was curious what your thoughts were with it in regards to how it could impact like a situation that said isn't happening, but naked shorting that situation. I was curious what your thoughts were on it, and if you could expand a little bit on the CAT system as a whole.
Sure, and I'll just say I'll do one more question. I think I'm hitting my limit, but I'm happy to join.
Oh no, I have a payment for order flow question.
This whole time.
Well, how about we could let the average Abe take that one then. There's always room for this in the future, so we do very much appreciate it, Dave. Like, thank you so much for taking the time out of your evening.
It's so informative for us. We really appreciate everything. Again, thank you so much. And then JB, if you want to take the last question.
To be honest with you, JP, average JP's been waiting so patiently. I've seen his mic go on mute like 7
No, I'm
times.
sorry. I didn't even know who that. I thought that was.
No, he's a knowledgeable guy. Hey, average, what do you got to ask, brother?
All right, I just wanted to ask a quick question on the
Respect. That's why I love these guys. Wait. Mm-hmm.
That some firms claim to be able to do, but I think quantum computing is pretty far away, and none of them are being run on anything like that.
Okay, and on that note, Dave, I truly, on behalf of me and JP, and then everybody that's listening to learn, I genuinely appreciate you taking your time, as I know you're a busy guy and you're not feeling well, to come and get questions drilled like this. So I genuinely appreciate it from the bottom of my heart that you came out and took this time.
Yeah, I gotta say, it's very cool to me that people care about this. I've said it before. I've been doing this for a while now, and no one's really cared about it. Like sort of this small group of kind of market structure nerds, and we talk about this kind of stuff a lot. And then, Flash Boys help, but this has been a whole new thing. And it's really cool that people care about it, and I like talking about it. So, like I said, I'm happy to come.
I'm going to call it there because my laptop's about to die and my phone's about to die. So, I just wanted to have that stream so you guys could see it and whatnot and listen to it if you're not on Twitter. So I'm going to get back to work. Thank you to anybody who's listening, all the questions and whatnot. Sorry I couldn't get to them here. Dave has a limited schedule. I didn't want to throw in any unneeded noise from myself. So that was the reason for being quiet. And, that was kind of a little peek into the more professional side of me, quote unquote. Thank you, everybody. I'm going to cut it there. I will be in the Discord text-wise and Twitter. So thank you all so much. Twitter is @thatguyastro. I will take care of myself. I'm good. In my car right now, by the way. So, again, Twitter, over right there, right with my right here. There you go. So, all right. Thank you so much, guys.